I'm Charlotte McLeod with investingnews.com, and here today with me is Ken Hoffman, Head of Commodity Strategy at Red Cloud Securities. Thank you so much for being here. Great to have you.
Thanks for having me. Really excited to talk about gold and precious metals.
Really good to have you here today, and we are going to get into gold, the precious metals. I think it's going to be an exciting conversation. Just because it is our first time talking, I'm thinking that our audience is probably familiar with you already, but if you could give a brief introduction to your background and your current work, I think that would be a nice place to start.
Sure. I've been working in commodities and metals going way back. 1991 is when I got my first analyst job at a place called Prudential Securities. And so I've covered the commodity space from starting as an analyst, and then I became a portfolio manager. I've run a energy and basic materials fund, first quartile fund, then worked for a bunch of very large hedge funds, including places like Millennium Securities, in terms of investing in the commodity space. I moved to Bloomberg, where I started a group there called Bloomberg Intelligence, where I ran all their gold and precious metals and base metals research. And then I did something completely different. For about a decade, I went to McKinsey & Company, which is a large consulting firm, where I worked on strategy for the metals and mining company, a lot on the battery space, but also in the precious metal space as well. And so I've particularly when I was at Bloomberg, I did an awful lot of stuff on gold, and sort of happy to come back to the market these days because I think there's just incredible opportunity ahead.
Well, and what better time to be returning to gold? So we'll get into your thoughts on gold. I know that in the long term, you've got a $10,000 price target for gold, or it's a level that you think it could get to. So we'll jump right in, and I'll ask you, how do we get to that level? Gold has really been on the move this year, and 10,000 feels, I think, more in reach than it ever has, but it's still far into the distance.
Yeah, and that number, when you start doing the math, that number could be conservative. And again, I go back and do a little bit of a history lesson. After World War II, the world decided that the U.S. was the leading country in the world, and the U.S. wanted us on a gold standard. The reasons for a gold standard were pretty evident. We came through a period from the late 1800s to up to World War II, where we had a lot of problems with tariffs, a lot of problems with inflation, a very volatile economy. And so the best thing about gold is it's very consistent. The production of gold every year, you add about 3 to 5% to the stockpiles of gold in any given year. So it doesn't allow countries who are tied to a gold standard to really go nuts and spend a lot of money, which causes inflation, et cetera. And that really lasted until the Vietnam War, when the U.S. needed to spend an awful lot of money on the Vietnam War. And so what we saw is the U.S. government go off the gold standard because they needed to crank up those printing presses. What that did was twofold. It sent the price of gold from around $35 an ounce up to $800 an ounce in around 1980. So in less than a decade, you saw, almost what are we talking about, 25-time increase in the price of gold. What people had said is like, look, gold's sort of untethered. Everyone has the printing presses going. It's reached a new reality. But then in 1980, we saw another sort of shift where President Reagan came in. He did a number of things. One, he raised interest rates to over 20%. And so since gold doesn't have an interest rate, a lot of people moved money away from gold and into dollars. He also started something called the Plaza Accord, which was sort of all the currencies in the world sort of getting together, again, cementing the US dollar as the major trading currency. And he was also such an open, free, and fair trader. It really positioned the US dollar as the currency that the world would use. And if you had that, you didn't need gold. And so you really went from 1980 to really 2000, where the price of gold did absolutely nothing. Start 2001, we have unfortunately 9/11, and then we have the global financial crisis, and then we have the COVID years. All those were areas where the world had to print huge amounts of currency, and in order to sort of keep the global economy working, what the U.S. did and other countries did was to lower their trade barriers to try to increase trade to get the economy going. But all that considered, it sort of told central banks around the world, wait a minute, we've been selling our gold all the way until 2000 because who needs it? We have the dollar. Now, all of a sudden, you're finding other countries, particularly China, coming to the fore, and they're not trading with dollars. They're 72% of the world's trade in 2000 was gold, was US dollars. Today, that number is under 50%, and it's really starting to fall off a cliff. So now if I don't need dollars, let's buy gold. And as a matter of fact, today, central bank's second largest holding is gold. So now we come to today, and why have we started off to the races, and why are we going to continue to go to the races? We have a complete change in the world economic order. Again, very similar to what happened after World War II. The U.S. is no longer interested in free and fair global trade. And so they've instituted these tariffs going from 2% to close to 20%. And so that's going to stop a lot of trade going on. And if I don't need to trade with the U.S. so much, I don't need their dollars. And so you see the selling of dollars. And for an investors, the one index you need to watch is called the DXY. It's the dollar index. It's sort of a basket of what the U.S. trades in. As it falls, the price of gold goes up because it's literally people selling dollars and buying gold. And so as the DXY has fallen, and it's fallen about 10% this year, price of gold usually is about a 3-to-1 ratio. So 10% decline in the dollar, 30% increase in the price of gold. The U.S. has said, and you've seen, Trump sort of talk about these things, that what he wants going forward is lower interest rates. So lower interest rates means I don't need to hold dollars. Less trade, I don't need to hold U.S. dollars. And he wants a weaker dollar, something there's called the Mar-a-Lago Accord, which is to devalue the U.S. dollar versus other currencies. And Trump seems pretty committed to that. So all those things mean we probably go to the lowest the dollar has been over the last 20 years, which is about a 30 to 35% decrease from its current levels. So that's about a doubling in the price of gold. So that starts to get you from 3,400 to about 7,000. And then once we have that momentum and people are sort of out there saying, well, wait a minute, the U.S. is no longer going to be the main currency. What could be a main currency? And the only currency that no one country can attack is gold. It has no central bank. It has no politics. It has no committees. It has no political agenda. And that's why you see particularly, and I was in Asia for 2 weeks, at night when you would meet a lot of wealthy investors, a lot of family office people, they're like, we want gold. We're putting our money into gold. I think in Singapore, there's a 10,000 metric ton, like Fort Knox there, and family offices and wealthy people over there are just selling their dollars and putting it into gold because they can see where this is heading and they know it's a great investment. And I think that's going to continue that momentum, and gold always tends to overshoot. So 10,000, 12,000, 15,000 is just their numbers, but I think they're quite reasonable.
So it really is based on history. You can see how that could play out for sure, just based on how you've laid it out there. I want to talk a little bit more about what's coming for the dollar, because when you talk about things like de-dollarization and dollar going to its lowest level possibly ever, I think people hear that and they wonder, okay, how does this really look like? Is the dollar going away, or is it more like it becomes de-emphasized? So how would you explain it?
I do think you have a couple interesting things. I mean, already what you're seeing is, how tariffs are impacting in the world. I think fruits and vegetable prices in July of this year rose by more than 40%, the largest increase on record. So there is a lot of this is tied to people just don't want dollars. They're taking the currencies elsewhere. And you have sort of the puzzle pieces don't fit. You can't institute a big tax, which tariffs are, which again, consumers are starting to see. So they're purchasing less, which is slowing down the US, which means that I'm purchasing less from overseas. So there's even less need for dollars. At the same time, we're running near record deficits. So you need dollars for that. Okay, normally in order to stabilize the dollar, what you do is raise interest rates. And this is very similar to what happened with Nixon in the 1970s. If you go back and look at history, it's amazing how it repeats. Nixon went against the Fed. Nixon tried to replace the Fed. Nixon was arguing for much lower interest rates. Why? Because he was running big trade deficits and didn't want the big cost that comes along with that. Plus, the economy was being hurt by the higher interest rates of the day. And so he's like, just lower the interest rates. And at the end of the day, what that did was really hurt the value of the dollar. and send gold prices, we said, from $35 to $800. That type of situation seems like it's playing out all over again. You have Trump going after the Fed. He wants much lower interest rates, yet at the same time, we're running huge budget deficits, which need to be paid for somehow. And all these things are coming together where, again, every one of these things is a tailwind for gold. There's really nothing sitting in gold's path going forward. And I think, large times, really good times for gold have been there, but I think they continue, and particularly into 2026. I think things could change if there's an election in 2026 and all of a sudden Trump isn't allowed to do as much as he is sort of with these tariffs, and, even tariffs on like India and Brazil are sort of, nobody really knows where he's going with this. All these things are doing damage to the dollar, which again, it seems like he wants. And again, how do I hide in a refuge if I'm an investor? It's gold. And I think there's, that's been the momentum and it will continue to be the momentum.
Yeah, nothing in gold's path. I think that's a very, very strong way to put it there. And I'm wondering, so in the scenario that you're laying out, what are the implications for the US economy? How does that end up looking as we move forward here?
Well, I think, I'm doing some work on copper right now, and I'm looking at this. I mean, I think the U.S. has a severe slowdown next year. In my viewpoint, I think all of these things of, probably one of the largest tax increases in history. Again, you see it in the price of goods in the store. So it's not, I'm not paying more tax, but I'm paying more in the store, which you're seeing that. I think that slows down the U.S. massively next year. Again, if I lower interest rates to try to help that out, because, we are starting to see, the weekly unemployment gains looks like they're going above 2 million people for the first time since COVID. And you're starting to see all these things. That's going to be the pressure where Trump will see, we need to lower interest rates. But again, that might not do too much good, because if I can't afford anything, I can't afford anything. But what it does do is tell investors around the world, why are you holding dollars? And again, there's going to be a really interesting push and pull where if I lower interest rates, but I'm running deficits, that means I need someone to buy that debt. And if no one really wants to buy it because they don't have to hold dollars anymore, that means interest rates go higher. And I think the Fed's biggest fear is this: they cut interest rates, but the real interest rate that you see in the 10-year and 30-year bond do not decline. And that happened a bit last year when they started to cut rates in September, October last year. The long rate didn't really move much. And so what's scary from an investor standpoint is if the Fed no longer controls interest rates, then markets do, and interest rates are going to go wherever they want. And that's just not good. But again, that's all the destabilization of the dollar. And again, as an investor, all you care about is, okay, if I'm not going to go to the dollar, where do I want to be? I don't think I want to be in euros or yen or other currencies, because in that case, the U.S. could go after that. Hey, everyone's buying Swiss francs. I'm going to put a 50% tariff on Switzerland for everyone buying their currencies. If it's gold, there's no one to attack. There's no one to tariff. There's no one to go after. And so it's a great place to hide in areas of high uncertainty.
Right. You can definitely see how it all connects. And I promise we'll stay on the track of gold, but just because you mentioned you're doing this research in relation to copper, I'll ask you briefly, what is your outlook for copper? Because of course it's Dr. Copper. It tells us how the economy is doing. So what are you seeing for copper?
Well, I have to make the opening statement on copper during LME Week. LME Week is when all the copper buyers and traders around the world descend in London, and I'm just starting to put together my speech for Red Cloud. I think next year is really difficult for copper, but it's hard to judge because, so for example, this year, the dollar has declined by 10%. The price of copper in U.S. terms have gone up 10%. So if I'm anywhere else in the world, my price of copper has been unchanged. So, do you say, what is the copper price in dollars, or what is the copper price that most consumers around the world are paying? And that's sort of difficult. But we do see that copper growth will slow from around 3% this year to about 1% next year. And the U.S. copper demand will probably decline by about 6% next year from this year's levels. And this year will probably be down 1% to 2%. Again, it's, particularly in the U.S., you had a 50% tariff on copper, which sent the price of copper from around, $3.50, $4 range to over $6 range. I was talking to some contractors who were saying that their monthly bills in terms of the building material, which is pretty copper heavy, had doubled since a year ago. And because of that, they had to increase their prices to their customers. And so they were seeing a lot fewer customers. I think that ripples through the system next year. Now, I think what happens beyond 2026 is actually incredibly positive for copper. And that is, one of the things you hear a lot about is AI. Like, AI is the term we hear about every second of every day. Well, to make AI work, you need these server farms. These server farms are massive in terms of power needs that they have. So much so that the one place in Europe that was building a lot of server farms was Spain. Spain built like 6 massive server farms. They used so much power to stabilize the grid so much that the entire Spanish electrical grid collapsed. And so now what you're seeing is huge amounts of backup power being added to there, but not only there, but to China and to the US. So much so that I think by 2035, more batteries will be produced for backup power, not only for solar farms and wind, but every business out there worried about the grid being destabilized by AI is going to want backup power. Battery backup power has become super cheap. And so you're seeing this unbelievable growth of 100% in 2024, 200% this year, and probably another 50 to 100% next year. That uses, not only the copper that's in the batteries, because the batteries all use a lot of copper, but the wires that go into these battery packs, and then the infrastructure and transformers and everything else that you need. I think copper really catches a tailwind from this. And once we get through a period where the US isn't so disruptive using tariffs, and you see this huge tailwind from all these backup grid systems going up because of AI, I think copper has a great 2027, 28. So it's a little tricky. If you're a short-term trader, you're probably a bit nervous about copper over the next 6 to 18 months. If you're a long-term holder, you love copper for the long term, because I think the demand for copper is going to be unprecedented, because, again, the switching of the world over to massive needs for electricity. And that's why you hear, China building the world's largest hydroelectric dam ever. Why you hear the US talking about nuclear and other forms of electricity coming in. A lot of it comes back to people foresee how much power demand. And to show you how much, I did a study for a server farm, one server farm, and you might have seen Tesla has something called a megapacks, which is like a trailer car. To hold just 48 hours of electricity for one server farm, you would need 7,000 of those megapacks. So the power demand is just phenomenal. And we are building, as I haven't seen the videos coming out with earnings today. I don't know where they are, but all that's AI, trillions of dollars going into it. And again, the only way we can secure the electricity for that is to build a lot of copper. And I think that's where it comes to play.
That gives us a really good picture of the magnitude of copper demand. Just a small follow-up on the supply side, because obviously we're going to run into a crunch there. How are countries around the world doing in terms of speeding up copper supply, getting the projects approved, the mines online? Because it's a very, very long process, and of course we're going to end up needing it.
It is. And I mean, in the United States, it takes around 29 years to get a copper mine up online. I know the US government's trying to cut the red tape, and that if they do a great job and cut all the red tape, and there's a lot of silly things done with mining permitting. For example, if I have a mine in, say, Nevada, first thing I need to do is Nevada's going to come in and do an air permit and do all this testing for 6 to 9 months, and then be like, okay. And then when theirs done, the federal government comes in and they do their air testing. And then they come up with slightly different things, and so they have to go back to the state, and then that goes on for a year or so. Then they finally, okay, air permits permit. Now we have to do the water permit. Like why they all couldn't do all of these permits, which are sort of codependent, at once together, is something I think needs to be done, and I think it's starting to be done. But even if you had a perfect scenario where all the permitting was done perfectly, synced together, there wasn't so many things stopping mine development, you still are talking 8 to 10 years. for a mine. Just how do you have to plan it, permit it? You have people underground, you don't want them collapsing. You have a lot of equipment, which takes many years to build because there are almost always specialized pieces of equipment for that mine site specific. So you do have a very long time frame, no matter where you are and no matter where in the world you are. So the world is going to have a difficult time finding this copper. And the only way to really incent, this to move any bit faster is a higher price. And so I know there's a lot of guys out there like Robert Friedland who just say like, look, copper's going to have this great run. I can't argue against him because the electrification trend and AI is unstoppable, which means demand for copper is going to be very, very strong, particularly I think after 2026. And so the price of copper should go significantly higher in order to either incent copper, or at a certain price, then you're going to use alternatives. There's, aluminum and other different metals that could be used to sort of supplant copper. But I think copper has a really good run because it's really good. Where it sits on the periodic table is great for electricity movement.
Okay, I think that gives us a nice look at the full scope of copper. So I'll go back over to gold. And so you're talking about the central banks obviously have woken up to this need to own gold. They've been buying and buying. And you mentioned your travels in the East, people over there definitely want gold. So I'm wondering, when does the West start to wake up to gold a little bit more than we've already seen at this point?
Yeah, when you talk to portfolio managers, they don't have large gold holdings. And you talk to most investors out there, and I'm sure a lot of people watching this podcast are probably gold bugs. And so they're like, wait, I own gold. Like, I'm really into this. But when you go to the general public, their holdings of gold, their holding of gold mining companies is near nil. And so I think what happens is you'll continue to see the price of gold do very, very well. I would not be surprised if central banks continue to accumulate gold and the dollar continues to be less and less of world trade. Remember, we've gone from 72% to under 50% in the last 25 years. As we get to 40% or 30% of global trade, there's going to be a need for an alternative. And I do think gold-backed currencies make perfect sense. Unlike cryptocurrencies, they can't be hacked. And my biggest sort of black swan event for the next 2 years is this quantum computing comes so sophisticated and nefarious folks get a hold of it and start cracking the codes much quicker than the security of these cryptocurrencies can handle. And all of a sudden we wake up tomorrow morning to trillions of dollars in losses. You can't do that with gold. And so I think gold really becomes to the fore as sort of a global stabilizing currency force that it's always been for thousands of years. And at that point, people realize they have to own gold. They have to own gold miners who are producing the material and have the value in the ground. And I think then gold becomes much more mainstream. But I am still shocked when I speak at gold conferences. And, I at Bloomberg, where I was for a decade, I would go to a lot of gold conferences. I would be on your podcast as well as others. It's almost a decade later I'm going, and there's a lot of the same people from a decade before. There hasn't been sort of a new and energized and younger crowd really interested in gold. That needs to occur, and I think it will occur.
Well, definitely, I think if what you're outlining there comes to pass, people are going to have to wake up to gold. And you're right, many people in our audience do own gold. They own gold stocks. But I want to ask, okay, so if we have gold going to 10,000, it sounds pretty appealing. You could just own gold and you would do pretty well. But if we get into looking at the gold stocks, I'm wondering where you see the most potential if people wanted to go into the companies.
Well, I do think, I really like to follow the JDXJ. It's the Junior Gold Mining Index. It's very liquid. It has pretty broad coverage. I wish it had more junior miners in there, but it is what it is. But I've done some research on it. It is currently trading between 75 and 80. If I look historically where gold trades versus the JDXJ valuation, it should be closer to 300 today. Just on historic valuations, if you look at the premium of gold over the cost, which is at all-time record highs, These companies are just not getting any sorts of historical valuations yet. Yes, it's up about 80% this year, so it's had a good run. But if I went back 25 years and just mapped out where the JDXJ has been versus the price of gold versus the margins they're getting, which is a huge value of the what you're getting in the ground, you are talking closer to 300 for the JDXD. Now, if we were to go to 10,000, obviously, it's quite astronomical. And so what starts to unlock it? Yes, slowly but surely, we have seen that, these juniors do better, but I think you're going to have to see acquisitions. I think what you're going to have to see is, I can go on my Bloomberg right now and I can hedge out gold to, I think, about $6,000 30 years from now, and it's quite liquid. So, you may see some companies say, wait a minute, I have this miner with this great asset. I can produce it, say, $1,500 an ounce for the next 20 years, and I can hedge it at, $4,000, $5,000, $6,000 over that time period. It's free money. Why don't I do that? I'll acquire this company. Or you'll see a lot of other mining companies, start to say, wait a minute, I need to have gold as part of my portfolio. As the value of gold goes up, the revenue goes up, it moves the needle more for these bigger companies. So I would expect acquisitions, probably bigger acquisitions, I would say, some of the major miners. But as that occurs, what you're going to see historically is just a rapid roll-up of smaller names. And so you'll start to see these names rolled up, and they're so cheap, I think it happens relatively rapid. So it's going to be a bit of a flash sale, I think. Once it starts to see, you'll see one of the major gold miners acquired by one of the real big miners. And then all of a sudden people are like, wait a minute, this is why they're doing it. This is how profitable it is. Like, what do we, why are these things trading so cheap? And then boom, there's, as you say, there's not a lot of broad ownership. As soon as you start to see that ownership sort of broaden out, and the people who do chat rooms and things of that nature say, wait a minute, here's these gold companies trading at 3, 4, 5 times cash flow. That's ridiculous, and something that's so valuable. And then you'll really start to see it go off to the races, and that's where I think the JDXG has just a phenomenal run, and these companies do very, very well.
So we are due for some M&A activity. That is difficult to say in the gold space. We have seen some deals so far. I'm wondering what you make of the transactions that have been taking place so far in 2025. Are you liking what you're seeing? Do they make sense to you?
Yeah, the deals so far this year make a lot of sense. I think you are seeing a pickup in M&A. It's slowly but surely starting to go there. But if you look historically, and really if you look at the time frame of the late 70s, or the time frame really in the early 2000s, you saw a lot of the names. And a lot of the names I used to cover as an pup analyst back in the 90s, Homestake, Battle Mountain, a lot of these other companies, they all got acquired. And they all got acquired relatively quickly when the price of gold sort of took off, and people were like, wait a minute. Now, at the end of the day, while you could hedge out and make guaranteed returns, a lot of companies don't do that. They like to have the price exposure. But still, I think what happens is, people tend to follow others. And so I think you need a few more deals to be done that are a bit more high profile, to where the bankers start going around to all the companies and saying, hey, do you realize how cheap these things are? This just isn't right. And then it starts feeding frenzy. Now, look, if the price does go parabolic, it's going to be really hard to sort of say, okay, we've done enough here. I had to go to the London Metal Exchange Week a few years ago. One of the reasons they always invite me back was I was the bear on lithium when it was near $70,000. And I was like, lithium's really common. This is a bit ridiculous where the price has gone, and people were throwing tomatoes at me. But the money was there. The money was made at that point. You need to know that things are cyclical, and things will go down. But I do think we're, not even the first batter has come to the plate in the first inning here. I think we have quite a long ways to go. But I do think once it starts going, first of all, I think your podcast viewership is going to go up like 100-fold. But I do think, let's wait for that to occur. But everything is lining up right now for that to occur. That's really great.
Still early. I always like to hear that, because it means there's so far to go. Okay, so we've got a good picture of what's happening with gold. I have to throw in a question on silver, because if we're talking about $10,000 gold, people are of course going to wonder what is coming for the silver price, especially right now with all this talk about gold silver ratio and what's going on there. So what are your thoughts?
In silver, I've never been a ratio person, and I know people love the ratios and things of that nature. In general, what you see is, a rising tide does lift all boats. And so if you talk about silver or platinum or palladium, I think silver closely follows gold. And so if we do see gold continue to have a pretty significant run, silver should be fine. Again, it's sort of also seen, it's not really held by central banks because it's not a tier one asset. The big change for gold came a few years ago in Basel III when they made gold a tier one asset, which means that from an accounting standpoint, I count the value, 100% of the value of gold. Before, I could only count 50% of the value of gold. So there was less allure to owning gold. But when they said, hey, it's a full currency, now could there be pressure on central banks to make make silver a tier one asset and fully valued? That's possible. But I think there's always just a coattails of silver to gold. So whatever is good for gold is good for silver. And we have seen silver have a really nice run here. And I would think the two together do quite well. Platinum and palladium are a little bit different. Yes, they are precious metals, but you have to worry a little bit about them in terms of when they're an industrial metal. And as I said, I think industrial demand next year could be soft. And two, the movement to EVs, which, if you look at China, where I was just there, about 40% of the cars sold now are EVs. And in Europe, it's about the same. The more EVs produced, the less catalytic converters you need, and therefore lower demand for platinum and palladium. So there are some industrial things you need to consider with those type of metals and how that impacts overall demand.
Yeah, all the precious metals are slightly different, even though we group them together. So
Yeah.
thank you for going into that. And I'll let you go, but before I do, I just want to ask, are there any other areas of the resource sector that you are interested in or focused on right now? You've got such a broad background. I'm sure there's other things you're keeping an eye on.
Yeah, I mean, if I were in the space, the one thing I'd look at, and it's very niche, but is manganese. In terms of battery demand, we are seeing this unbelievable increase in battery production. I think a lot of people, particularly in North America, they say, well, EVs are dead, everyone hates them. But over global battery production this year is going to be up about 60 to 70%. Most of that is going towards stationary storage. Now, if I'm a battery company, I need to get my cost as cheap as possible. And the way to do that is to actually switch from iron phosphate, which most batteries today in the world are made, it's called LFP, to LMFP, which is manganese iron phosphate. What that does is it gives you a battery that has maybe 50% more energy density and is cheaper than LFP. Having just been in China a few weeks back, production of manganese powders in 2023 was 1,000 tons, not much. Last year was 10,000 tons, okay. First quarter of this year, 25,000 metric tons. And when I was there in China, they think this year could hit 250,000 metric tons and then 500,000 metric tons the year after. So, manganese is going to be sort of a really important metal for batteries. That hurts nickel and cobalt demand, by the way, but it does help manganese demand. Don't just buy anything with the name manganese in it. Make sure that company can process the manganese into, first of all, battery grade material and then into powder. What we've seen in the West is the value chain doesn't exist. And so if I produce manganese powder in the US, I then have to ship it to Korea to be made into a manganese precursor, ship it back to the US to be made into a final battery powder. There are companies in the world that actually can give you the full value chain and ship that final powder just to a cell maker. And those companies exist in China. There's a couple of them trying to exist outside of China. And if they do, that's going to be really, really huge for the battery business. So watch manganese. I've been a huge manganese bull for years. I gave the opening speech at PDAC 3 years ago when I said it, and people were like, it's not going to happen. It's happening in China, and whatever happens in China, battery-wise, happens in the rest of the world. We're just a little bit behind.
Well, really interesting. Thank you for mentioning that one. It sounds like a tricky one for people to address, but definitely an opportunity if we can figure it out. So thank you so much. This was really great to have you on.
Thanks you so much for having me, and hopefully we'll come back when the price is a lot higher and discuss. When we're at 10,000, we'll say, okay, we told you we'll get here now. Now let's calm down a bit, which people don't like to hear at that point. But ride the wave that we're going to have occur right now.
Absolutely. We'll make sure to have you back, hopefully along the way to 10,000, not just when we get there. So I'll let you go for now. This was great. And for now, once again, I'm Charlotte McLeod with investingnews.com, and this is Ken Hoffman.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.